how can I protect my family home in my lifetime? Because we've talked about critical illness, we've talked about health insurance, education insurance, but I think the family home is a significant part of our lives, whether we're here or not. But in our lifetime, Naomi is going to tell us how we can protect family home.
Yeah, so this is protecting your mortgage debt. So if you have a mortgage over here and you want to protect your family home, and make sure that if you were to die, that your family are left the property unencumbered, so without a mortgage, then this is the type of insurance that we would be talking to you about. And this is very popular. So if you have either a buy-to-let mortgage or a residential property, and you've got a mortgage on that, then you can protect that debt. So this is an example of £1 million life insurance over 25 years for a couple that are 45, and you'd be looking at a premium of £109.37 a month. So again, that's life insurance. It's life insurance which we would link our advice to the term of the mortgage. And again, those premiums are fixed and guaranteed. And just to give you an example, because it's such it's such an established market in the UK, we have such a large book of business which is advised on, and it's so historically we've had such a big book of business. Now you can see that the sheer volume of claims that are coming through. So last year in 2020 we had 3.4 billion paid out in life insurance claims, and that was an increase of 10% from 2019, and a lot of that increase was due to COVID. So we saw a lot of an increase of life insurance claims in the UK, and we were very prominent in coming out, I think, and telling people, yeah, we're paying extra claims here. This is what we're paying for. We're paying because people have claimed against COVID, and that's why we're paying. So there are no exclusions under life insurance. If regardless of, I know it sounds morbid, but regardless of how you die, your life insurance will cover you. You know, if you die from an accident or illness, the life insurance here covers you for all eventualities. And that's been shown and highlighted with the rise of the pandemic. So really important.
So again, one other insurance that I think is different from the mortgage protection insurance is just buildings insurance, which typically when you're buying a property in the UK, if you're buying with a mortgage, at the point of exchange of contracts, which is the time you sign your contract and pay your 10% deposit, you are obliged usually by your mortgage lender to take out buildings insurance to ensure that if the building was to, say, catch fire or something terrible happened in terms of a hurricane or some tree falls on the roof or something, between the time when you exchange and actually complete and take possession, the building is at your risk. So the building insurance policy is different from the mortgage protection policy. And I know that I have spoken to clients who have thought that they had mortgage protection policy because they took out the building insurance policy at the time of the mortgage. So I just thought I'd put this in there to clarify that there is a difference. And so that's I think just worth mentioning at this point. Just wondering if there are any questions. I mean, one thing I just thought I'd again point out that I'd highlight is in the last 2 years, there's the uncertainty, I think, and with COVID, around COVID, and which has affected people's health in weird ways, unexpected ways, and expected, and unfortunately taking a lot of our loved ones. I think this is a question of what are we doing today to plan for that eventuality, that unfortunate eventuality, which we're hoping less and less people will get touched by. But, here as an advisor, I have unfortunately to interact with some families where there's been, the suddenness of COVID has affected, the life of the breadwinner. And without, and even though you might have assets, but if there's debt on the assets, or if there's very limited liquidity, or if there's just debt on the business, you might just find that there isn't enough liquidity to pay the school fees or pay the, even the health costs, or, other things, the mortgage costs, and suddenly, the family's life is totally thrown into mayhem. One question here, again, does a gift insurance over cash in the bank cover cash in the bank as well as property. So again, you mentioned being able to insure against, giving a gift to your beneficiaries in your lifetime. Naomi?
Yeah, so if anything which would cause a possible inheritance tax liability. So anything, if you had, for example, large sums of money and you're concerned about, if you were to die, what would happen there? So I guess it all depends on it, and everything is based on a need here. So if you have a property, then it's easy for the insurance company to see and work out that there is a need. If you have children over here, and they are dependents, then there's a clear need there for family protection. So as long as there's a story, what I'd say is, as long as when we talk, there's a reason that you need the insurance, then we're able to kind of place that. It's not necessarily just linked to a property, although property is an easy way to start that conversation. It can be, I'm living, between Nigeria and the UK, and I've got my children in education, and I'm worried about, if something was to happen to one of us, the school fees, or, living costs, because it is expensive to pay your bills and pay expenses. So it's quite a fluid thing, but there just has to be, a reason, I guess. It can be any reason, but there is a reason behind it.
I mean, also just to add to what Naomi is saying, and also trying to answer that question further, when we talk to clients about inheritance tax planning, and yes, we do say sometimes whether it's easier to add the children onto the title of the property, or there's a portfolio of assets, liquid assets, money in the bank, which you want to give to your child, and you make a gift in the UK, because that money, inheritance tax applies to any assets in the UK. So if you've made a gift in the UK and you die within 7 years, that gift, there's a clawback. The Inland Revenue can ask the beneficiary who's received the gift and spent it, for example, to pay inheritance tax on it. So you give your child £100,000, towards to buy a flat. There's no tax at the time she receives the gift or he receives the gift. But if unfortunately the donor of the gift, the parent, passes away before 7 years, then suddenly there's a tax. It triggers a tax event. And yes, I think the answer is you can insure against that.
Yes.
And linking this back to some of the structuring we've been trying to do, because as many people realize that they've owned properties which were held through offshore companies or trusts, and the UK government decided that that was no longer going to protect any foreigners from inheritance tax liability. And we're having to take the companies out of the properties from the companies into your personal names. And I'm saying sometimes hold it jointly with your adult children. That event is a gift. When you decide to add your adult child to the title of the property, it's a gift, and unless and until you have lived past that 7-year mark, there's an inheritance tax risk. So if you're doing that sort of restructuring of assets, and you're deciding to move property out of a company into your family names, then insuring against the risk of inheritance tax is something that's worth doing. I hope that